Thank you guys for coming. For those of you who didn't come to the last one, glad you're here this time. For those who came back, glad that you were willing to come back. So last week we sort of talked a little bit about the history of shareholder activism. We talked a little bit about the issue spectrum and what kinds of issues come up. We talked to you about the variety of different players. And this week what we're focusing on is non-contested situations and some behind-the-scenes influence that happens in the space. And next week, at our final of the three-part series, we're going to talk more about proxy fights, PR wars, and kind of give you a little bit of a little behind-the-scenes peek, I guess, as well at that. But those will be focused more on situations which you would have read about and heard about in the press. Since Evan already introduced us, for those of you who didn't know us before, I'm not going to go through that again. Why don't I just turn it over to Mason, who's going to walk us through sort of the beginning, and then I'll loop back in here along the way.
Sure. Thanks, Abe. So last week we talked about three themes. This is working or not. The one that we're really going to hammer home today is this point about activism being a lot more than you read about in the newspapers. I really firmly believe that this is where the revolution is happening. It's behind the scenes, and this today is going to be one of the few situations in which I personally publicly speak about what it is I do all day. And I'm going to share with you some redacted board books and some other things that'll bring a little bit of this to life and hopefully make this interesting for you guys. And Abe's going to tell you some more stories as well. We're going to go, the framework is we're going to go back to the issues spectrum we talked about last week and then provide some examples and war stories from the perspectives of various participants, activist investors, institutional investors, and proxy advisors. I'm going to be talking about boards I've served on, some of the people I've served on boards with, some of whom are here tonight. I also know that we have somebody from ISS here tonight, so we're going to be speaking badly about all of you people, so just get ready. So the issue spectrum, just to remind you guys, we started with non-economic issues and walked our way all the way up to board composition, which is generally the most hotly contested issue. We also reviewed last week the landscape of various service providers. I'm sure some of you guys are here today, and we'll try to offend you guys as well. You got the proxy advisors advising the shareholders and a variety of advisors advising the companies. This is data that one of the advisors, Credit Suisse, an investment bank, pulled together that tracks the outcomes of proxy fights. And since we don't really know the results of the friendly advances that activist investors make to boards to get on their boards, which is 90% plus of what ValueAct does, would not even be captured here. But this shows you that 78% of proxy fights were settled before they went to a vote in 2011. And again, if we're probably on the extreme, but I think this is the tip of the iceberg. There are many, 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 many more boards that are accessed by activist investors that you don't even know about because they're not publicly reported on by the press. We're going to jump right into the issues with the non-economic issues, and I'll turn it over to Abe.
So look, I'm not going to spend almost any time on non-economic issues, but they're on the spectrum. The reason I'm not going to spend very much time on them is because investors don't spend that much time on them typically. There are a whole host of different issues that come up that shareholders have that are put on ballots, and we talked about this last time. Is typically these issues are put on by people who are focused on something other than economic interest. Now, it doesn't mean that there's not a nexus between these issues and economic issues, but the motivation behind what those people are doing is often not an economic issue. It's more about a social issue or environmental issue. So some of the things that we were particularly focused on, can you click ahead to one slide?
Yeah, and by the way, the framework here is the stars are supposed to represent some kind of qualitative level of engagement and interest level. So you can see the activist hedge fund at 0 interest and moving up to the advisors.
So charitable and political contributions is a big issue on ballots this year. It's actually probably one of the ones that's going to be very interesting to watch because I think we might see some movement on this, even though historically shareholders have not supported almost any of these issues. Animal welfare is another issue that often comes up, hydraulic fracking, coal, carbon emissions. discrimination or non-discrimination on regarding sexual orientation. I've actually seen it both ways. Sometimes you'll see a shareholder proposal that says that the company should remove their non-discrimination policy, and other times you'll see that the company should adopt a non-discrimination policy. And then, landmines, all kinds of issues come up. I highlighted two of these, animal welfare and landmines. I'm just going to kind of give you a little behind-the-scenes issue on the animal welfare one. I mean, from my experience, this can be a very impassioned issue. You'll see some things on ballots on it. When we were at Barclays Global Investors, because Barclays Global Investors was a huge shareholder in Huntington Life Sciences, some of our executives were targeted by folks who were strongly opposed to what Huntington Life Sciences is doing, and they had to get sort of all kinds of personal protection at their home and other things because of the aggressive nature of the engagement, let's just say. Landmines, I thought I would just highlight briefly, and the reason I did was because this is an interesting issue, and I told you, some of these issues do have economic consequences. Some of them are tied. They might not be, the proponent may not actually be focused on an economic issue. They may be 100% focused on a social issue. But when you're on the receiving end as an institutional investor, when I said we don't spend a lot of time on these, I just mean to say there's a lot of them that we think are very much board questions. We just don't think these are shareholder questions. It's not that they're not important. It's just that they're not questions that belong to the shareholders. Those are questions that are typically reserved to a board and from a shareholder perspective. But every now and then you'll see one where you want to dive in and at least ask a few questions, understand, well, is there something going on here that the company really isn't managing? And so there was one proposal a couple years ago, I remember, at Lockheed Martin. And I think the company was rather surprised when I called them to talk to the CEO or whatever about this landmine shareholder proposal, because they thought of it as this sort of social proposal, didn't have anything to do with anything. At the end of the day, if my recollection is we didn't support the proposal, but we talked a lot about it because there was a question about whether Lockheed Martin was in particular vulnerable to some economic consequences for having built or designed landmines that were being left in various places around the world where there was a lot of potential future damage and harm that could be caused by those landmines, and whether they might have some liability. And so we thought that it was sufficiently interesting from an economic perspective. And again, remember, as an institutional shareholder, our job at BlackRock or BGI or any other big institutional investor is not to tell our clients what they should think about social policy. It's to represent our clients' economic interests. And where there's a legitimate question about economic interests, then it's reasonable, I think, to have a conversation and perhaps even to vote with a dissident on one of these things. But so my point on this is there's a lot of different issues that come up. We'll probably spend a little bit more time on this next week because some of these are more public and today is sort of the behind-the-scenes look. But here's a couple where, over time I had to spend a decent amount of time at BlackRock and BGI dealing with sort of in a behind-the-scenes way because there was either something there in the case of landmines that we really wanted to understand from an economic perspective, or in the case of animal welfare because, the CEO of our parent company and all these senior executives were being targeted in sort of violent and somewhat scary ways around these issues. So that's my quick look at the behind-the-scenes issues on non-economic. Mason's going to dive in next on the next segment of the issue spectrum. So
this occupies the bulk of my working hours, which is once you've gotten on the board, then what? What are you going to do? And the challenge that you have in the job of the activist investor that serves on a board is you may be one of 8 to 10 people on the board with one vote and no ability to drive the agenda necessarily. And in my particular case, I've always been quite a bit younger than the other people on the board with a much less impressive resume than the other people on the board. I've never run anything, never managed anything, and a lot of these people have. And so the challenge is how do you influence a room of people that are much more experienced and older than you? And the answer is not to come in guns blazing like you know all the answers and you're so smart and they're so dumb. It's in my experience, the best way to do it is to work collaboratively with them by analyzing information and making fact-based decisions. Now, this is a chart I really love. I don't know if you can read this, but this is a survey McKinsey did, and it relates to, they asked directors questions about their level of understanding of the business, and it really is amazing to me that 34% of directors reported little to no understanding of the dynamics of the company's industry, and 32% said little to no understanding of the risks the company faces, et cetera. I would have expected those numbers to be like low digits, and instead a third of the directors have no idea really what's happening in the industry. And that's not really their fault. I am firmly of the belief that most directors are very well-intentioned, very smart people. They just don't have the time and information that they need. And so a lot of what we do at ValueAct is trying to bring information into the boardroom, because all we do is invest. So we know the industry inside and out because we've met with everybody in the industry. We've met with customers, we've met with suppliers, we've gone to trade shows, we've met the CEOs of all the competitors, we've weeded through everyone's different strategies, we've listened to earnings conference calls for every company. We know what's going on, and we subscribe to industry data publications. We can bring information to the board that they don't already have, and by the truth shall set you free. It is amazing what happens when someone like me, who's young and doesn't have any particularly impressive credential, comes in and works with people who do and have maturity and wisdom and judgment. Some of them are here today, and I bring the facts to bear. And this is one of my favorite. I'm going to show you some board books here. This is a company I was on the board of when I was 32 years old, and the board was largely former CEOs. And the message that we were getting from the company, I don't know if you can read this, but it shows the growth rates of the company's products, and it was positive 6.4%. The message we were getting was companies growing and taking market share, which is a very nice message to hear, and everybody congratulated the CEO on growing and taking market share, and it's great that we're growing and taking market share. However, I knew that while they were growing 6% and they represented 25% of the market, there was another player that had 50% market share that was growing 16%. It doesn't make any sense to me that you can be growing and taking market share when somebody with half the market's growing almost 3 times as fast as you. So this was my first board meeting. I wasn't particularly welcome at this point, and viewed with a lot of suspicion, I think, as a lot of activist directors are. And so I asked the simple question that I didn't get it, because I just listened to this competitor's conference call and they're growing 16%. Can we maybe see a little bit more information than this? Because this isn't enough information. This is just percentage growth. Like, why are we growing? Can we see the units, the pricing, the foreign exchange translation? What is driving this growth? And a couple of the older guys piped up and said, yeah, I'd like to see that information. That'd be good. So there was a clue, which was that if they reported foreign exchange adjusted growth, which you can see was negative for most of these regions, and what was driving the growth was the depreciation of the US dollar versus the euro. And that kind of started to tip me off that something was going on. And so the next board meeting, 3 months later, we got this, which showed the units were actually going down 15.7%. So when this data came to light, you had suddenly a bunch of well-meaning, smart guys who said around the boardroom, wait a minute, you told us you were growing and taking market share. What happened to growing and taking market share? And so the dynamic of the room completely changed. And I went from being kind of an outsider on one side of the room to included in the discussion. But the point of this anecdote is a little bit about the lack of information and transparency that boards have, and the lack of time that they really have. And frankly, without sounding self-congratulatory, if all you do is study numbers as a financial analyst, you're going to be better at studying numbers than somebody who doesn't do that. And so the positive attributes of combining that kind of analytical skill with the wisdom and judgment of ex-CEOs and other leaders is a pretty powerful thing. And this resulted in replacing the head of this division, replacing the head of sales, and came very close to replacing the CEO, but we sold the company before the clock struck midnight on him. But that was a...
Priya back here has a question. This better be a softball, Priya. I forgot to say at the beginning, we're gonna have time at the end for questions, but we would love to hear from you right now. There's a microphone over here, though, if you want to come talk to us, we're recording. So let Mason keep going on, and then you want to... Okay, no worries. So could everyone hear, the question was, did management actually, does Mason think that the management actually understood what was happening here? Were they trying to trick the board, or were they actually themselves sort of not fully up to speed about what was really happening at their company, and they were sort of getting metrics passed up through the chain and thought that it all was good?
So it's speculation. I think in many cases, I don't think they were trying to defraud the board. I think management teams, particularly ones that are very sales and marketing oriented and not particularly numerate or math, can sell themselves on a story that they totally believe about why they're doing really well. And I think in this case, the explanation turned out to be, well, we are growing and taking market share in this subset of this type of product in this region every other Tuesday kind of thing, right? It was like, it was one of these, their new products were growing really well, which again misses the point because that competitor has new products and old products too, so it really isn't apples to apples. But I think it sold themselves on the view that they were doing really well and momentum was picking up and everything, and they were, but you never know, right? I'm not them. But I think a lot of that happens. People, this goes to the CEOs always have the upper hand because they cherry pick the data that they want to put in the board book. There's no regulation about what to put in a board book. It's completely up to the CEO and up to the board whether they think that the information is satisfactory or not. And I would say, without fail, it's unsatisfactory when I arrive for the types of analysis that I like to do. So, anyway, so good things happen when you information. We're going to segue over to compensation, which I think everybody cares a lot about. And forget if I go first here. I think I do.
Yeah, you do. You do.
So this is compensation. We could probably do another 3-part lecture series, complaining about compensation. But again, this is something that I think a lot of activist investors are very well schooled at, and it's not. I don't think we're ingrained in the way a typical public company looks at the world, but we are ingrained in how does an owner of a business think about sharing the upsides and the economic value created in an enterprise with the management team versus the owners of the business. And so when I have gone into companies, I've really tried hard to get out of the classic compensation committee and compensation consultant frameworks, which is what's up here, which is very, frankly, dumb in my view. Because what you're doing here is you're taking apples to oranges across 15 different companies and you're comparing them to each other. Every compensation system is very different. RSUs are very different than options, are very different than performance share units, are very different than bonuses. And the exercise every company seems to do is shoehorn all that stuff into one simple number because they like simplicity and compare. So here, this is a company I'm on the board of. If you, conclusion you would draw from this analysis is we're at the 97th percentile of total direct compensation, so therefore we must be wildly overpaying our people, right? This is the type of analysis I like to do. Now, each of these black boxes are covering up comparatives to the company. And the scenario analysis that I had my analysts run and show to the compensation consultants who then ran it for the board is as follows. The green bars represent the lowest risk level of compensation. This company we're talking about is on the left-hand side of the dotted line. So if you to earn into the yellow, orange, and reds, you need to start compounding for 3 years at 15% shareholder return, 30% shareholder return, and 45% shareholder return. So the reds are the 45% shareholder return over 3 years, which is tripling your stock price, which is pretty hard to do. And the point of this analysis is if you look at our greens, if we do less than 15% a year, our executive here is actually among the worst paid in the group. We just drew a line here across. But what we've set up is an accordion that really inflates and rewards exceptional shareholder return. The other thing that's neat about this structure is that it gives a relatively constant percentage of the equity value created to the executive, which is the way that VCs, private equity, and even investors in hedge funds think about sharing the spoils of upside returns with their agents, is defining it in terms of percentage of value creation, not in terms of a simple dollar amount that goes across, that you can try to apples to orange across a lot of data points. So trying to get this is taking a one-dimensional analysis and turning it into a two-dimensional analysis, and has had great results for this company in particular. I actually, some of these things are a little bit laughable. The ones where you have you get $15 million in green for not doing very much is a bit silly. I also think it's a bit silly to have almost no discrepancy between the companies on the right between mediocre performance and truly, truly world-changing, outstanding performance. So this is the type of kind of risk-taking and thinking outside the box and not falling into the traps of the standard compensation committee that I spend a lot of my time working on and has a big impact. Obviously, the executives, the right kind of executives, really like this because it rewards them for doing well.
So we talked a little bit about, in each of the 3 sections we've covered so far, the non-economic stuff, the strategy issues, and comp, on how investors think about this stuff. So we also told you we'd give you some perspectives from the other players here. And so I wanted to take a pause on the compensation piece. We're going to do a little bit more, but talk to you a little bit about what's going on in the proxy advisory world. So for those of you who pay attention or have any sort of background in corporate governance, you'll know that the proxy advisors, these are the firms, there are really 2 of them, Glass Lewis and Institutional Shareholder Services. And again, as was noted at the beginning, I was one of the founders of Glass Lewis, so you can just, take everything I have to say with a grain of salt. But, I was also a huge client of both Glass Lewis and ISS, probably ISS's largest client for 5 or 6 years while I was running corporate governance at Barclays Global Investors and BlackRock, and had very good relationships there. So I don't have any axe to grind, but I'm just giving you my disclaimer. So these firms, in particular ISS, because it's the biggest, it's been around the longest, and for some other reasons we're about to get into, are relatively reviled by the corporate world, right? They're not shareholders in these companies. Professor Larker here has actually done some research on this topic, and which has been used and cited by folks suggesting why the proxy research firms are not that good, and it doesn't make sense, and they're not really doing anything that's valuable. I'm not saying I agree with that. I'm just saying that that's the main sort of knock, as we talked about last week, on the proxy advisory firms. Well, my view about this actually is that it stems almost entirely from compensation-related issues. Now, granted, there are always going to be people who don't like the proxy advisory firm recommending against their board, or saying to vote against something with the management. So people will be upset, whatever. But I think the real seething underlying anger at proxy advisory firms actually comes around compensation. So let me tell you why. Well, Mason walked you through 2 examples. He gave you sort of the traditional comp consultant kind of look at comp, and then he also gave you the sort of smarter, more thoughtful, more in-depth, specific company, thinking about how to stretch these goals and get an executive to really take it up to the next level kind of approach to comp. And I guess what I would say is the proxy advisory firms, first of all, they tend to have to write research on thousands and thousands of companies every year. And the people for whom they are writing research also own shares in thousands and thousands of companies. And so what investors rely on proxy research for, and what actually proxy research from my perspective is quite good at doing, is identifying issues. It's an issue spotting tool. It's like, do you need to worry about X, Y, or Z? And then if the answer is yes, you need to worry about X, Y, or Z, then you can dive in. The proxy research may not be enough, it may not be well done, it may not be whatever, but if you get both Glass Lewis and ISS, and you do your own research on top of it, you're pretty likely to be able to kind of take that summary of what's going on and then spot some issues. Well, on compensation, this is really hard, because what the proxy advisory firms try to do is sort of shoehorn, as Mason was saying, everything into a very rigid kind of black and white model. And that just doesn't really work very well. And unfortunately, for ISS, they also decided then that they were going to create a consulting business around this, where they were going to advise companies about how to pass and get approval under their shoehorned comp model, which is probably the least impressive part of the proxy research they offer. And so companies felt very, very frustrated that they had to pay ISS like $30,000 or $50,000 a year to run their comp programs through the ISS model if they wanted to sort of see how they were going to fare before they actually put them out for a vote. Now, ISS makes and made a lot of money doing that, but it created this real resentment. Companies sort of felt like, well, hey, why is this fair that I have to? First of all, this model is terrible. It doesn't tell you anything about anything. That's what they would tell you. And it's like the worst part of the proxy research that they do on our company. And I got to pay all this money if I want to figure out how to pass it. And the reason why companies would be willing to pay to figure out if they were going to pass it is because this is the one part of proxy research that investors actually really follow. So there's this whole notion out there. Another reason why proxy advisory firms are so hated by companies is because they're viewed as sort of controlling the world. Well, I'm here to tell you as an institutional shareholder, or having represented institutional shareholders for almost a decade, that institutional shareholders do not, by and large, follow proxy research. They have their own guidelines, they have their own way of thinking about stuff, and they do the work on their own. But as I started out by saying, it's really hard to model comp for thousands and thousands of companies. So hiring a proxy research firm that, in theory, has dedicated all this time and energy into designing a really great product that you can sort of rely on as a good way of issue spotting in comp is very convenient. And most institutional investors don't have the insight of Mason or his team of people that are working and focused on 10 companies for their thousands of companies they hold. And so what you wind up with is shareholders really relying on this part of research. So again, you've got proxy research, which is already recommending against something, so companies are not particularly predisposed to like it. And then you layer on top of the fact that it's not very well done when it comes to comp, and it's the one thing shareholders actually rely on and use in voting. And you have to pay if you want to sort of run your model, your plan through this thing, and you wind up with this sort of explosive level of frustration. So if you ask me, if you read in the press, you see things about why ISS is terrible, this and that, you read some of Dave's papers, I think it comes down to this sort of underlying sort of seething feeling about the comp models. So I'll give you a little history and then I'll tell you what's happening today. So I put up here ISS's equity comp model is called SVT, Shareholder Value Transfer, was their whole notion of how they were going to look at executive compensation. At Glass Lewis, when we first started, I put in question marks and quotes. I'm not saying this is true. Our CEOs used to say that the shareholder value transfer model was the incorrect calculation of an irrelevant number. Because really, if you looked, we had all kinds of examples of situations where you could pass ISS's comp model with flying colors, but actually be presiding over like total destruction of value at a company. And it's because it was a very rigid model. Glass Lewis, we came on the scene in 2003. We tried to do better. We tried to design a model that we thought was sort of smarter and more reasonable. We looked at compensation over a 1, 3, and 5-year period. We tried to measure the total value of what was ultimately given to executives, both the CEO individually and then the top 5 executives collectively, over those periods, and then compare to a variety of different peer groups. We were trying to avoid sort of peer group bias. I'm here to tell you in retrospect, it was better, but it still wasn't very good. And so fast forward to today, there is a lot of work going in, both at ISS and Glass Lewis, into trying to refine these models and trying to make them better. But trying to do this all in a model-driven way is just very, very difficult. And given the fact that shareholders need sort of shorthand, or maybe they don't need it, but maybe they shouldn't need it because maybe they should be investing more in having people look at thousands and thousands of comp plans. But the reality is they're using it. It's a really difficult area. So one thing that's interesting that's happening, I'll just throw out there, and after, I wanted to give you this background, but one thing that's interesting that's happening out there is there's a company in the Valley called Equilar. You may have heard of it. Dave Chun, I think, is a Stanford grad, and he spends a lot of time at the Rock Center. He's done something interesting, at least on the peer group front. What he's doing on the peer group front is he's created this model where you can decide whether you think the company is being reasonable about the peers that they're comparing themselves to by looking at every one of the companies on their peer group list and seeing if they, in turn, list the company as a peer and who they say their peers are. And he does this sort of very complicated relationship web mapping to try to ultimately hone in based on sort of the company's own disclosures of each other and what they see as, who they see as their peers to kind of get to a place where you have a reasonable peer group. And peer grouping can be one of the biggest issues in looking at comp in a reasonable way, because if you are comparing to the wrong peer group, so CEOs often like to compare themselves to, Microsoft or Intel or something, some huge company that, there might be the tiniest little thing, but they're like, oh, but we're in computers. So, all that computer stuff, it all should be in the same bucket, So point is, there's some work happening here. I think the reality is that, and one of the reasons that I've never been a particularly big fan of SayonPay, and there's been a lot of debate in the shareholder community around SayonPay, despite the fact that, and SayonPay, by the way, is this rule that came into effect last year in the United States that allows or requires shareholders to vote on companies' compensation plans. And I think it's a mistake because shareholders are not particularly good at this. They're good at looking ex post and seeing whether the company has paid, what the ultimate value that was delivered to executives, whether that lined up with performance relative to peers, especially if you got a good peer grouping tool. But they're not at all good at doing what Mason was showing across thousands of companies and deciding ex ante, oh, this is a really good comp plan at this company, or this is a really bad comp plan. And so as a result, I think SayonPay is likely to create all kinds of other issues. But in any event, the point is there's a lot happening in the comp space that sort of is probably not fully transparent or open for people to really see. And I kind of wanted to give you this little flavor of how this is happening at the proxy advisory firms and to what extent the institutional investors are relying on it or not, to give you a sense of how complicated and intractable an issue this is.
And it's a really important issue for companies because pay obviously really matters to the executives. It's also really important because we talked last week about some of the history and how much has changed in the last 10 years. I think there were two forks in the road that we didn't really dwell on last week. One is 2006, the CD&A rule that made companies really be much more explicit about how they think about pay, what's their philosophy, why do they pay their executives the way they do, what are the performance measures. And then we had the SayonPay, which percolated for a while and then came into effect last year. Those had a tremendous effect. And I think one of the major reasons is because with the SayonPay votes coming, if the company lost, and it was a referendum on not just the executives but on the comp committee members, and if they didn't get their acting gear the next time, ISS and Glass Lewis would recommend withhold votes for those compensation committee members, which meant that the board members were facing the very embarrassing scenario of getting thrown off boards, which in my experience, embarrassment is the #1 motivator for directors. It's like they do not want to get embarrassed. And so what you saw in advance of this is some data, it's a little bit dated, but you saw a real house cleaning going on because the shareholders now were going to start voting in a way that had real ramifications on the board members and the directors. And so this is when we talk about this quiet revolution. I don't know why it took so long, but all of a sudden everybody started getting their act together. And this is another board book, again redacted. This is the first page of the comp committee's book for one of our board meetings. ISS is mentioned 3 times, 3 out of 4 bullets. And the whole board meeting, sort of the comedy and the tragedy of this whole thing was we had to get our act in gear and clean up a lot of the bad employment contracts that we had. But the whole exercise was geared towards solving for what ISS would sign off on, right? And it was disappointing to me that you didn't have a discussion about, do we have the right philosophy? Are we incenting the right behavior? Are we holding people accountable? It was all about how do we game this ISS system. So Abe just threw ISS under the bus for its thought process, but what's happening is everyone is marching to the beat of that drummer and the Glass Lewis drummer, which I think is a real, I guess directionally it's good that people are being more responsible, but it's the specificity with which people are approaching this task is pretty sad, I think.
Now, before you get too depressed here, I want to throw in a couple points. So the first point I want to say on the last slide is, what you don't see there, and this maybe will make you more depressed, and then I'll try to make you less. What you didn't see on the last slide is that because SayonPay was coming, a lot of stuff had to work its way through the system. Companies had promised things to executives contractually, and in order to clean things up to be prettied and ready for shareholder viewing, there was a lot of money spent and a lot of money changed hands. Stuff that might have been deferred, it might not have actually cost shareholders that much money. In order to get rid of those things and pay them out, they got paid out in order to avoid embarrassment through SayonPay. Again, a reason why I think SayonPay not the greatest idea, because that's not really what should drive compensation decisions.
That's exactly. In fact, in this company we were talking about, we basically, to clear the decks so that prospectively we look good, we essentially made the executive whole for everything they had gotten.
Paid them out for a bunch of stuff, yeah, and paid it in an accelerated way, in a way that actually probably cost shareholders more money. What I will say, in order to sort of hopefully leave you slightly less depressed on the topic, is that boards don't have to choose this path. Now, I am telling you that investors probably overweight proxy research and proxy advisory recommendations on comp issues exclusively. But a board that is really engaged with its shareholders or willing to go out and really talk to its shareholders, if you do something, if you come with Mason's chart and you say, let me explain to you how this comp program works, and it might look to you like it's going to deliver way too much money to the executives, but let me show you specifically how this works and why this is exactly the program that you want. Shareholders are absolutely willing to engage in that discussion, and if done well, you can get around the proxy advisory firms. They recommend against you, it doesn't matter. The problem is that there's so many thousands of these things, and most companies are not all that interested. As we talked about last week, there's a lot of companies that are like, listen, you don't like it, sell your shares, or hey, we're not really going to go out and talk to every one of these shareholders, it's just not our thing. Well, then they are going to get stuck with the results of the proxy advisory firm, and the shareholders probably aren't going to have the right red flags in every instance to dig in and get a more thoughtful approach. But companies that do engage can win despite a negative recommendation from both proxy research firms. So slightly more positive note there. Okay, so sorry, did I cut you off on your last topic there? All right, so shareholder rights. Can you skip forward one slide? So I really was just going to kind of tell you a little inside story that I think is interesting about this topic. And it's really a story about this whole topic for tonight, which is about how there's a lot of behind-the-scenes influence and a lot of engagement that's happening out there that you just don't read about and you don't see about. And I actually learned about it in this example firsthand. I was the new head of corporate governance at Barclays Global Investors. At the time, Barclays Global Investors managed about $1.7 trillion or $2 trillion, something around there. It was the largest asset management firm in the world. We were the largest or one of the largest shareholders of pretty much every single major company around the globe. And I was like in my second week on the job, and the general counsel of a Fortune 10 company, huge company in the US, called me and said, hey, Abe, I used to meet with your predecessor, once or twice a year when I was in town. We would talk about, what was coming up on our meeting and, just keep engaged and have an open dialogue. And I was sort of new. I hadn't really figured out, well, what's my engagement strategy going to be? Like, which companies I'm going to talk to, when am I going to talk to them? So I didn't want to say no. I thought, well, if she was doing that, I should probably consider it. So So I said, sure, come on in. And he was like, okay, I'll be in town, next week. And came by. We had a very nice 45-minute in-person discussion, told me about what was coming up on the proxy, or what they were expecting. They hadn't released their proxy, and was just sort of talking to me about governance issues in general. What was my philosophy? What was the firm's view on certain things? And we talked, about a whole host of governance issues. One of them was whether, we had a view about lead independent directors. The board, did we have a view about separating chairman and CEO? And if so, what was that view? And did we have a view about lead independent directors? And was that a good thing or a bad thing? And would we, since I explained we actually had a very strong view about separation of chairman and CEO, we thought that was the better outcome if possible, but we would settle for a lead independent director. But if there wasn't a lead independent director, we might be uncomfortable with that, and here's why. Anyway, long story short, he leaves. I mean, this was maybe 2 minutes of a 45-minute conversation from my recollection. He leaves, calls me 2 days later, and he says, hey, I got back into town. I flew home after I met with you and met with our CEO yesterday. We had a very nice talk. I shared with him all of the things that you shared with me about your governance structure or your governance views. And because of our conversation, we decided we're going to appoint a lead independent director. And we'll put it on the proxy at the next meeting. And I was like, okay, great. And my mouth was sort of like wide open. And I was thinking to myself, okay, so I get how this is going to work. I'm going to need to be really careful when I have these discussions that I stay totally on message. And fortunately, I had stayed totally on message. And I didn't ask them to do something crazy or, I don't know. I didn't give some personal opinion about some random topic. I was very much on task. But what I realized was, wow, like we, as a huge shareholder in these companies, and as a shareholder who was viewed as very thoughtful about these issues and not particularly activist, and we never were out embarrassing anybody in front of the public, when we spoke, when we engaged with our portfolio companies, they listened and they acted. And so it sort of sent home for me the magnitude of this role that I had accepted and what my responsibility in that role was. But it also, I think, paints a little bit of a picture about this whole theme that we're covering tonight, which is there's a lot happening behind the scenes. And if you engage in a reasonable and respectful way, and you approach issues with boards and management teams with an open mind and hearing their views and sharing your views, and they don't view you as a threat, but instead as a sort of thought partner and an owner in the business, you can really have a huge impact. And over the course of the years, there's lots of other stories I could tell you, but I won't bore you, on different things in which we engaged with companies. But this was a particularly meaningful one for me because it was right at the beginning, and it really sort of sent home a very strong message to me about the ability of our firm to really have an impact and what I needed to do in my role to make sure I did that responsibly. So moving on to the last topic, and we're getting kind of close to our 10 minutes to mark, and I want to make sure we have some time for questions and discussion, hear what's on your mind, and maybe just give you some thoughts on that. The last issue here is board comp and M&A, and I was going to share one story here. If we skip ahead, this was back a couple years ago. There was a contest to acquire equity office by Blackstone and Vornado. Blackstone was if I remember this right, Blackstone was in a deal with equity office to acquire the firm. Vornado came in and it put out a higher bid, and all of a sudden this very public bidding war ensued, and there was this sort of down to the wire vote on how shareholders were going to vote on this deal. Were they going to vote for the Blackstone deal or against the Blackstone deal, thinking that there was this other better deal out there? And it's an interesting one because there's all these questions you have to ask yourself when you're in my old job and when you're making these vote decisions. One is, we had kind of looked at this situation pretty closely and spent a lot of time looking at the economics. And once this sort of bidding war happened, we were sort of thinking to ourselves a lot and talking a lot internally about what was a price where we thought we were at a good point to support the Blackstone deal, which was the one that was up for a vote. And we kind of got to a decision about that. And then I realized, well, we don't really want to cast our vote on that today. Like, what if we cast our vote? We were the largest shareholder, I think. You know, if we cast our vote right away, then that's a signal to Blackstone, like, hey, you don't need to raise your bid. You're good. You beat Vornado. So then we kind of developed this whole discussion internally about, well, how can we be strategic about the way in which we vote in these situations, and what is it that we should be doing to ultimately try to drive as much value as we can? Because obviously, from our perspective, we might have gotten to our threshold and said that would be fine, but we'd be even happier if they added another $1 or $2 a share, especially since we owned millions and millions of shares. And for our clients, we want to maximize value. So it was a very interesting process internally, and we sort of developed some guidelines around thinking about this, where we sort of decided we would wait until very late in a contest like this to cast our vote ultimately, because we'd want to incentivize the companies to put as much value on the table as possible without sending signals that, hey, we're good, you got to our number, we're happy. But it's a little tricky too, and then there's also the question of, well, there's a lot of engagement that happens. So at some point along the way, the CEO called me and said, I'm thinking that, this number would feel good. Does that feel good to you guys? And we sort of had this very interesting back and forth. And I was like, well, and so the point of this story is there's not too much more to say, except that thinking about, there's just an interesting lesson here about the way in which shareholders use their votes and exercise their votes, and the way in which they can control their own flow of information to try to ultimately maximize shareholder value. And it's not always easy, and sometimes you're playing a little bit of a game of chicken because you don't want to send a message that you don't want. What if you get to a place where you're pushing so hard that one of the parties walks away or something, right? So there's this sort of delicate balance that you have to do, and a lot of it's based on instinct and experience and sort of having smart people around the table thinking about the right way to approach it. But there's a lot happening behind the scenes that you don't see in these situations that can ultimately have fairly meaningful impact, and in the case of a transaction, really meaningful economic impact, because this is a deal where it came down to the very last minute, and we held our vote until I think we cast it on Sunday night for a Monday meeting, because all through the last few days there were price bumps back and forth until they knew that they were going to get their 50% threshold, and they knew we hadn't voted. They kept calling and saying, well, aren't you going to vote? It's the weekend, you're not voting, where's your votes? And they were just waiting to get over the 50% threshold. And as soon as they got over the 50% threshold, they were going to be done. But we sort of tried to keep our powder dry. Anyway, look, I hope that was a relatively interesting sort of view of some of these various issues that we talked about on the issue spectrum, and the ways in which they actually play out in the real world, in the way in which engaged ownership, activism can have an impact even if you don't really see it. And frankly, to go back to Mason's point at the very beginning, this is actually probably where most things happen in the activist space, or most things happen in the corporate governance space, because you read about the big salacious things and the big interesting fights, and the Carl Icahn's going after this guy, and the company's fighting back and whatever, but you don't read as much about some of the things that we're talking about. But this is really where the rubber meets the road, and where a lot of value is created or potentially destroyed if not done well. So why don't we have like 5 minutes left, 7 minutes left. Why don't we open up to some questions? We have 2 microphones, one here and one there. If you want to come up to a microphone if you have a question. Or, hopefully we have a question. Look at this. No. Question. Yes.
You haven't really gotten into the excitement, the role of governance and the role of all of the parties involved, etc. Everyone is driven by maximizing their return. I guess that's all the legal people, all of the investors, be they funds, etc., etc. And you've got this whole
So say more about, before you walk away, can I ask you a question? So I think it's a very exciting thing too. I mean, I've dedicated my career to it, so has Mason, so I don't think we disagree with you on the excitement thing. Oh, so, well, the question was really more of a comment to say that we haven't really captured the excitement.
Well, talk to the excitement. Why not talk to the excitement?
Well, next week, so come back next Monday, 6 o'clock at the law school, room 190, I think. And we're going to talk about proxy fights. We're going to talk about PR wars and the way in which the different players use the media to try to play gotcha with the other players. And kind of get into some of that stuff. But a lot of what's happening behind the scenes is not fireworks. It's a lot of communication. It's a lot of patience. It's a lot of 32-year-olds going to board meetings and trying to figure out a way to work constructively in that room where you're actually going to make some traction and make some headway. It's not, you know, the stuff that you read about in the journal is very exciting. And that's why we saved it for last, because we knew that you would come back for the last one. If we did, but I would say that a lot of this stuff isn't that exciting. I mean, but it's interesting every day, extraordinarily interesting. When you're such a large shareholder,
all these, you know, every example we talked about here, hundreds of millions of dollars were at stake from my fund. More than that for Abe's. You know, I mean, there was, you know, we didn't want to screw it up, and there were some very tense moments and some very human interactions. I mean, there's I don't know whether it's appropriate to talk about the email.
That's the other thing. The really exciting ones get a little edgy. Yeah, go for it.
Let's just say I've seen a grown man cry quite a few times. No, I got
my question's for Mason.
Yeah.
When you're initially communicating with a board or a management team and you're attracted to the situation because maybe you think they're not a good management team or it's a thorny issue, but I know you guys try to be constructive.
Yeah.
How does that initial call go? Are you telling them we're just interested in your board and we think we can add value, or are you actually kind of saying, here are the things we think you're doing wrong, and how do you keep it constructive?
Yeah, so it goes even further back than that. We start with only targeting great businesses that we think have levers to pull to create value. Now, we don't go looking for governance situations to fix. We don't look for companies that are doing bad things because that'll probably be a recipe for losing a lot of your money very quickly. So we start with the positive, right? This company can improve its margins, its growth, its capital allocation, its something, right? We spend a lot of time getting to know the people involved. One of the benefits of having done 27 boards now is we've got roughly 300 people we've served on boards with that can provide introductions and references for us. And you got to start, I think, to do this business the way we do it, humble, asking questions, listen to the story, give the team a fair chance. Usually, if we end up replacing management, it's not for a year or two into the investment. So we don't come in guns blazing. And if you take that kind of attitude, which I think is the high road, it's fair. You come in and you say, okay, we're going to go from point A to point B. You know, we're going to agree that it's taking margins from 15% to 20% and whatever, growth from 2% to 10%. And here's how we're going to do it. Here are the 10 initiatives we're working on. And then a year passes and they're going the other direction. Then you have the ability with a lot more leverage and not leverage for the sake of leverage, but you have, I think, demonstrated patience and you've done things the right way. And we have a lot of examples of that working out. And so it's a very slow process for us, which to the excitement point means it's a little bit boring. And in fact, when we file a 15D, it's rare that a stock goes up very much because people are probably rolling their eyes thinking, here goes another, 2 years of pain before we get any gain. But that we found that to be a much more effective way to go through our business. So it sounds a little bit wishy-washy and passive, but I don't think you can come in and boss people around from the outside, like you figured out everything. I mean, actually, there are people who do that and do that very well. I can't do it.
Yeah, and I mean, some of the people who do it, like people like Carl Icahn, they do it, but he has sort of a whole persona and reputation built over 30 or 40 years where, you know, the market just responds. Carl Icahn buys a stock, it goes up 5%. You know, I mean, it's sort of, and you know, that's not everyone's going to be Carl Icahn.
I was a little late, so I apologize if you've already addressed this, but what sort of, when you go in on these one-on-one private conversations with the companies, do you have like ground rules to make sure you're not inadvertently getting material non-public information for Reg FD or 10b-5 purposes? And that's probably a whole nother, you know, course, but it's, if you
yeah, so the answer on my end is every time I meet with a management team, the first thing I tell them, or a board, the first thing I tell them is, listen, we don't want any material non-public information. So we have some questions for you about your proxy, or we have some questions for you, we didn't understand your disclosure, or we didn't understand where you were headed here, but we don't want any material non-public information. Big institutional investors are in the business of trading. You can't trade if you're in possession of material non-public information, or at least you can't trade legally if you're in possession of material non-public information. And so, so we try really hard to make sure we avoid that. I did have one situation where a CEO accidentally disclosed something that he wasn't supposed to disclose because it was material non-public information. And his general counsel called me about 3 hours after our meeting and said, you know, when he talked about those performance metrics for his compensation plan, well, we hadn't disclosed those to the market. And I said, well, looks like you're going to have to disclose them to the market because we can't be in possession of material non-public information, and we are not going to rescue you from your CEO's decision to tell us something that he wasn't supposed to tell us. So you're going to have to just put them out there. And frankly, it's probably a good thing for shareholders if you do. And that's exactly what the company did.
Yeah, and same story for us, although we're willing to take the non-public information, obviously, because we're going to make a long-term commitment to a company and in many cases go on the board. So that trade-off when you step over the line, meaning you can no longer trade until that information is either irrelevant, stale, or disclosed is a big decision.
So I put together board packages for about 10 years working in strategy at several Fortune 500 financial institutions, and we talked a little bit about that. The CEOs that I work for, when I put the packages together, and the question here is who owns strategy? Because the CEOs always say, I own this strategy, the board can help me tweak it, but if they go against my strategy, they got to fire me. And that was the position of both of the CEOs that I put packages together. So we positioned it, and we never lied to the board, but we messaged and repositioned things to suit the strategy of the CEO. So in your both of your perspectives, who owns strategy for the company?
I actually think the boards should own it. I don't think most boards are informed enough to take that responsibility and are very, I mean, it would be charitable to say reactive. I would say passive on receiving it, right? I think every board member should think, how is the shareholder going to make money from here? What are our key objectives? Do I agree with those or not? In the world in which we live, unfortunately, I think most board members view their job as largely compliance and sort of a do no harm fiduciary perspective, which I don't agree with. Having said that, I'm not sure what would happen if we opened that Pandora's box and let all the boards weigh in and be setting strategy. I think they have to own it. I think the CEO can lead the discussion, but everyone's got to really, really get it. And as we know, a third of them admit little to no understanding of some key elements of it. So.
Yeah, I mean, I'd share Mason's view. I mean, at least the last part. I think boards really should own strategy. I mean, look, they should hire a CEO and a management team that they believe in, and they should let that management team and CEO suggest a strategy, and then the board should really, meaningfully do its due diligence and understand the strategy, and ultimately take responsibility for adopting the strategy. But it's not totally easy to say one person owns it or not, because I mean, if the board doesn't think that the CEO and the management team are coming up with a good strategy, it's not really the board's job to come up with a better strategy. It's the board's job to fire the management team and CEO and get a new management team and CEO that can bring them strategies that make sense. So I don't think the board needs to do the work of designing the strategy, but I think the board needs to own the strategy. If that makes sense. Yeah.
My view is you guys have been looking at this from kind of like two different points. I mean, you're on the inside, you're sitting at the board table, you're talking to management. But and I guess a couple of comments leading up to just a quick question, because I'd be interested to get your perspective. And I understand your point about not going in with guns blazing. I think that's probably appropriate. Most recently, and I see this from in my view, in my job, what I see day to day is that it's the individual investor is very uncomfortable with public markets. And I think all this analytical work, hopefully it creates a more thoughtful management that results in more confidence among public investors who are the owners of the businesses. But most recently, we've had the banking industry, for one, I mean, a huge flame out. In my view, the board wasn't paying attention. I mean, at 32 or 34% at AIG or at Lehman, or those were obviously somebody wasn't paying attention or somebody was acting fraudulently, one or the other. And most recently, a change in strategy, Hewlett Packard loss and a 50% loss in market value in a very short period of time. How do you guys, when you guys are looking at this stuff, what do you, clearly at BGI, I mean, you're talking, those are within the realm of what you're talking to, the folks you're talking to, and I'm not sure which companies you guys are involved with. But when you view those situations, what's your gut reaction? What's your reaction about the people involved? Do you have a reaction?
So I think that is a perfect segue into next week, Monday night, 6 p.m. for law school, for our third and final session, because we are going to be talking. One of the slides I've already started working on for next week is around big banks and a bunch of engagement that happened when there was one of the union funds actually ran a campaign against the boards of 6 of the big banks sort of right before the crisis. Well, the crisis was sort of already unfolding, but it was before Lehman collapsed, and it was before all the before Wachovia went away, and before Washington Mutual went away, we had a lot of engagement with these boards around what they were doing from a risk management perspective. In fact, I learned a tremendous amount about big bank risk management over the course of that particular proxy season. The upshot, which we'll talk about next week, was that we voted against board members at pretty much every company that doesn't exist anymore, and the ones that still exist, we actually didn't wind up voting against many board members. But I'll save more of that for next week. Mason, do you have any?
Well, I hate to let some of these people off the hook, but stuff does happen, right? I mean, business is risky, I think the big problem, though, is just a general lack of understanding of the businesses. I mean, it's very hard as a part-time board member, which is what every board member is, right? I mean, they're showing up a couple days every quarter to really get their arms around the real business problems that are affecting the company. And I think there's been a sort of regulatory overkill that's sucked up so much of the board's time in signing off on Sarbanes-Oxley 404 audits and reviewing the Ks and Qs and proxies and all the sort of compliance-related things that need to get done crowd out substantive business discussion. I mean, the business discussion is usually crammed into the last couple hours, and most people are like checking their BlackBerries to make flight reservations, and I think that I don't know how to fix that because there's a lot of work to do in a short amount of time, and I think to do a board really, really well, it's self-serving, but I think you really have to spend a lot of time talking to the competitors and the customers and doing all this work, taking the data that you're getting and plugging it into an Excel spreadsheet and look for trends and ask for more stuff, and that kind of stuff doesn't happen in the public companies. I mean, that's why private equity can succeed, is because they do that stuff and they buy a company and they really find where all the bodies are buried. So it's depressing, but I'm not sure there's a great answer for that other than put me on a few more boards and people like Abe. And I don't know. I mean, and you guys, I don't know. So long as there's inefficiencies out there, we can still make money, though.
All right, well, I think we're well over our time. Thank you guys very much, and we look forward to seeing you next Monday.